start this masterclass by asking you to guide our audience on how economic cycles and market trends can influence long term investment strategies and what analytical tools investors can deploy to navigate these fluctuations.
Yeah. So as you know, markets are driven, okay, by at least, I mean, fundamentally, markets are driven by earnings, right? Corporate earnings growth, how the companies grow will determine the market movement. But over and above that, what happens is that there are the economic cycles, okay, which also impact the market. And as you know, when the economy is doing well, or economy is in a growth phase, we see that the company's earnings, okay, grow at a much faster pace, right? And the market also tends to give a premium, right? Multiples also expand during that period. But we all know that economy never continues to grow at one particular pace. There are six cycles to that economy. We saw one cycle, okay, which more recently, right, which was kind of enforced because of an event, which was the pandemic, okay, which we saw in 2020 and 2021, where there was a sharp contraction in the economy. Similarly, we saw the one during the global financial crisis, right, when the global economy went through a cycle. So when we all economies go through these cycles, okay, where there is a growth phase, it peaks out, then there is a kind of a decline, and there is a kind of a bottoming or which happens. And according to that, the earnings fluctuate, and markets also tend to follow the economic cycles. Similarly, there are market trends which are there, right? So the economic cycles are slightly more longer term in nature, right? Okay, typically from a boom, okay, to the bust, okay, the period could be anywhere between 4 to 6 years, okay, in that period. Whereas there are short-term market trends also which are there, right? Which lead to, these are normally driven by liquidity events, right? When there is a huge money of liquidity which comes into the market, markets tends to move up despite the fundamentals remaining where they are. And when they move up in the short term, because of more money is chasing the stocks, the valuations tend to move up, right? And market becomes a bit expensive. Similarly, when money gets pulled out because of whatever factors, say risk off, the reverse happens. So once you understand these market cycles, you will know that the markets will react to that, and that's the reason why we get the volatility or the cyclical ups and downs in the markets. And understanding cycles is also important from an investor to decide, okay, how you should invest in the market, when you should invest in the market, right? So normally, when the economy is coming out from a bottom of the cycle, right, where it's the most gloomiest, that's a time where you'll probably get the best valuations, right, in the markets. Earnings are also depressed. So the when it recovers from the bottom, you able to play both the earnings growth, right? Because from a bottom, when the earnings are depressed, the earnings growth, as the economy recovers from that phase, you will see a very strong period of earnings growth. Just to give an example, I mean, after the COVID impact, we saw the economy contracted, and subsequent to that, we have seen that the earnings growth in FY22 and FY23 period was around 20% earnings growth, which is much higher than what the long-term trajectory has been, which is around 12 to 13%. At the same time, also we saw the P multiples also expand, and that's where the return in that period has been much higher. So I think when normally when the economy bottoms out, I think that's the time we need to increase the allocation. Okay, because invariably the economy will turn up, and you will see growth to be much faster. Similarly, I think when the economy gets into a growth phase, and it remains there for a long period of time, and we see that because of that, inflation starts to peak up. That's the time when one needs to be slightly worried, and at the same time, the market valuations are also kind of expensive compared to the long-term average. One needs to be a bit cautious and try to reduce exposure. So the analytical tool really to gauge that is an asset allocation model, right? Which we run, wherein we look at various parameters, right? Which is what is the valuation of the market based on the price to earnings multiple, price to book value, right? In relation to the historical levels where it is, how expensive it is or how cheap it is. Also, we look at in relation to the other factors like the bond yield, right? Because there's a correlation with the earnings yield and the bond yield. And then we superimpose that with the market economic cycle where we are. And then we come to conclusion, okay, what should be the asset allocation into equities based on these parameters. And that's an analytical tool which helps us to decide how much equity exposure we should increase above our normal target level, right? There's a median level which will be there for every investor based on his risk profile. So how much above that need to grow, increase that, or below that, to capture these cyclical ups and downs in the market, which are driven by economic cycle or liquidity driven market trends.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.